Confusion is the first honest thing the market teaches a man. Nobody comes into trading clear-headed. If they tell you they did, they're lying to themselves or selling something. Trading feels messy because it is messy, and because the human mind hates disorder more than it hates losing money. I learned early that the market does not explain itself. It does not slow down for your comfort. It moves, and you either learn to read it, or you stay confused forever. Have you ever noticed how the chart looks simple, only after the move is over? When I first watched prices, I thought confusion meant I was doing something wrong. I thought clarity would arrive one day like a bell ringing. But clarity never arrives all at once. It leaks in slowly, through mistakes, through losses, through sitting on your hands, while the tape does things you don't understand yet. The market is not chaotic by accident. It is chaotic because it reflects human behavior, and human behavior is never tidy. How could something built on fear, hope, greed, and regret ever look clean on a screen? Most traders confuse confusion with lack of intelligence. That's a dangerous error. Confusion is not stupidity, it's information overload without hierarchy. You're looking at too much and knowing too little about what matters. Indicators stack up. Time frames argue with each other. One candle says buy, the next says sell. And you ask yourself, why can't I see it clearly like everyone else? But everyone else is just as lost, even if they sound confident. Have you noticed how confident people get right before the market humbles them? The chart does not reward certainty. It rewards alignment. Price, volume, and time must agree, and until they do, confusion is the correct state of mind. The mistake is trying to trade while confused. A confused mind reaches for action to relieve discomfort. That's how overtrading is born. That's how capital leaks away trade by trade. The market waits patiently for you to show your hand, then takes advantage of your impatience. Why do you think the best opportunities feel obvious only after you miss them? Confusion feels messy because the market is a living auction, not a math problem. Prices probe. They hesitate. They fake strength and weakness. They punish those who demand immediate answers. When a stock is truly ready, it moves with purpose. Before that, it wanders. Most traders try to force meaning into wandering prices. They draw lines, adjust indicators, and talk themselves into trades. But the tape is saying, not yet. Are you listening, or are you arguing with it? Your job is not to eliminate confusion. Your job is to survive it. Capital preservation is the first form of clarity. When you stop bleeding money during uncertain periods, your mind sharpens. Losses cloud judgment faster than any chart pattern. A trader with shrinking capital sees ghosts everywhere. A trader with dry powder can wait, observe, and think. Isn't it interesting how patience becomes easier once you stop forcing trades? Confusion also comes from trying to predict instead of observe. The market does not ask for your opinion. It asks for your discipline. Predictions are comforting because they feel decisive. Observation is uncomfortable because it requires restraint. When you accept that you don't know what will happen next, you begin to trade what is happening now. That shift alone clears half the fog. Do you really need to know the future, or do you just need to manage risk in the present? Charts are not confusing by nature. Our expectations make them confusing. We want symmetry, clean patterns, and immediate follow-through. The market offers asymmetry, false starts, and delayed gratification. When a breakout fails, it feels personal. It isn't. It's simply information. Failed moves teach more than successful ones if you let them. But most traders are too busy feeling betrayed to listen. Have you ever stopped to ask what a failed trade was trying to tell you? Money mindset plays a quiet role in this mess. If you need the market to pay you today, confusion feels unbearable. If you treat trading as a long campaign, confusion becomes tolerable. Wealth is built by surviving dull periods and striking during clear ones. The problem is that boredom and confusion feel the same at first. Both lack excitement. Both tempt you to interfere. Can you sit still long enough to tell the difference? The market does not reward activity. It rewards timing. And timing only becomes visible after long stretches of uncertainty. Every big move I ever made money on looked unclear before it became obvious. Accumulation looks like nothing. Distribution looks like strength. By the time the crowd understands, The opportunity is already aging. Confusion is the entrance fee. Are you trying to skip the fee, or are you willing to pay it? Charts feel messy because they are compressing thousands of decisions into a few bars. Each tick carries emotion you cannot see. When you accept that, you stop demanding perfection from your setups. You stop expecting every trade to make sense immediately. You wait for confirmation, not comfort. And confirmation often arrives quietly, not with fireworks. Do you recognize quiet strength when you see it? A trader who learns to be calm inside confusion gains an edge that cannot be taught. It comes from watching, waiting, losing small, and thinking clearly while others rush. The market does not need you to be brilliant. It needs you to be disciplined. Confusion tests that discipline every day. Most fail not because they lack knowledge, but because they cannot sit with uncertainty without acting on it. And the strange thing is, once you stop fighting the mess, it starts to thin out, not disappear, just thin. Patterns repeat. Behavior rhymes, the noise separates from the signal, but only if you let the market speak first. That's where most traders stop listening. Charts feel messy when you demand answers instead of waiting for alignment. That single mistake sits behind more bad trades than any lack of knowledge. The market does not owe you clarity just because you showed up today. It doesn't care that you studied last night or that you feel ready. When you look at a chart and immediately ask, "What should I do right now?" you've already tilted the game against yourself. The right question is quieter. Is the market ready to show its hand? And most of the time, the honest answer is no. A trader who demands answers treats the chart like a puzzle that must be solved immediately. He stares at every bar as if it carries a verdict. Up or down, buy or sell. He cannot accept neutral. But the market spends most of its life being neutral, undecided, probing. When price is not aligned with volume, when time has not done its work, the chart looks confused because it is not finished speaking. Impatience turns unfinished information into false signals. Have you noticed how many trades look obvious only after you waited too long to enter them? Alignment is not a mystical concept. It is simple agreement. Price must move with intent, not just motion. Volume must support that intent, not contradict it. Time must allow the move to develop instead of snapping back immediately. When these elements line up, the chart looks almost boring in its clarity. Until then, it looks messy because you are forcing interpretation onto fragments. You're trying to read a sentence before it's completed. Would you trust half a sentence spoken in a noisy room? Most traders mistake activity for information. A fast-moving chart feels meaningful, but speed alone proves nothing. A market can move violently and still go nowhere. When you demand answers, every wiggle looks like opportunity. You see breakouts that aren't ready, reversals that haven't earned their turn. The chart isn't lying to you, you're interrogating it too aggressively. The market answers only when conditions are aligned. Everything else is noise pretending to be guidance. There's also an emotional reason charts feel messy under pressure. The mind wants relief. Uncertainty creates tension, and taking a trade feels like doing something productive. That action reduces discomfort, even if it increases risk. So you convince yourself the chart is saying something urgent. You lower your standards without realizing it. You call randomness a setup, and once you're in, every tick becomes personal. Is that really trading? Or is it just emotional bargaining with price? Waiting for alignment requires humility. It means admitting you don't know yet. Many traders hate that feeling more than they hate losing money. They would rather be wrong with confidence than patient with doubt. But the market rewards the latter. Alignment does not shout. It emerges slowly. It repeats across time frames. It leaves footprints. When you stop demanding immediate answers, you start noticing those footprints. Have you ever looked back at a clean trend and wondered why you didn't see it forming earlier? The truth is, you did see it. You just didn't trust it because it didn't arrive on command. You were busy asking the chart to entertain you instead of inform you. Alignment often begins quietly. A failure to go lower, a steady absorption of selling, a refusal to break despite pressure. None of that feels exciting. It feels dull, even confusing. But dullness is often the market resting before it moves with purpose. The trader who understands this doesn't get bored, he gets attentive. Charts also feel messy when you mix time frames without discipline. One chart says strength, another says weakness, and you demand a verdict immediately. But alignment takes time across scales. A longer time frame may still be digesting a move while the shorter one thrashes around. When you demand answers, you treat all time frames as equal and simultaneous. They aren't. The market breathes. It expands and contracts. Alignment respects that rhythm. Are you listening to the rhythm, or are you rushing the beat? Money mindset matters here more than people admit. If your position size is too large, you demand answers because uncertainty feels dangerous. If your risk is controlled, you can allow the chart to remain unresolved. Proper sizing gives you psychological space. That space allows patience. Patience allows alignment to appear. This is how risk management becomes a thinking tool, not just a safety net. Do you see how capital preservation buys clarity before it buys profit? A chart that feels messy is often a warning, not an invitation. It is the market telling you conditions are incomplete. The professional trader respects that message. He doesn't argue with it. He doesn't decorate it with extra indicators, hoping one will give permission. He steps back and lets the market finish forming its case. When alignment finally shows itself, there is less internal debate. The trade feels lighter, almost obvious. Not because it guarantees profit, but because it makes sense. Demanding answers creates friction between you and the market. Waiting for alignment creates cooperation. One drains energy, the other conserves it. Over time, the difference compounds just like capital does. The trader who waits trades less but understands more. The trader who demands answers trades more and learns slower, and the market keeps score quietly, day after day. Alignment never arrives on your schedule. It arrives when the market is ready, not when you are restless. That's where discipline is tested most. Most losses come from acting during uncertainty, not misreading direction. Traders like to believe they lose because they guessed wrong. It protects the ego. Being wrong sounds respectable. Acting too early sounds careless. But the market punishes impatience far more consistently than poor analysis. Direction can be fixed later. Timing, once broken, drains capital quickly. When you enter while the market is undecided, you're not trading direction, you're trading discomfort. Uncertainty is not a flaw in the market. It is the market's default state. Prices pause, test, hesitate, and reverse because participants disagree. Institutions accumulate without revealing intent. Weak hands move first. Strong hands wait. When you trade inside that fog, you are placing money on something that hasn't revealed itself yet. The loss that follows feels like bad luck, but it was actually poor selection of moment. Did you really misread the chart, or did you simply refuse to wait? A trader acting during uncertainty is usually responding to internal pressure, not external clarity. The chart hasn't confirmed anything, but the mind is already tired of watching. So you interpret neutrality as opportunity. A sideways market becomes a breakout in your imagination. A pullback becomes a reversal because you want it to be. The market hasn't lied. You just asked the wrong question. You asked, where might this go? Instead of, has it already started? Direction is easier than patience. Anyone can draw an arrow on a chart after the fact. The hard part is waiting until the market earns that arrow. Acting early creates losses that feel confusing because nothing was technically wrong. The setup wasn't broken. It just wasn't ready. And an unready market behaves unpredictably. Stops get hit for no real reason. Entries look foolish minutes later. Confidence erodes not because you lack skill, but because you forced timing. Uncertainty hides itself well. It often disguises itself as possibility. A range looks like a base. A bounce looks like strength. Volume flickers just enough to trigger hope. This is where traders convince themselves they are being proactive. In reality, they are guessing. And guessing with money feels different than guessing on paper. Once you are in, your objectivity collapses. Every tick matters too much. That emotional load amplifies the damage of even small losses. Misreading direction usually comes with information. You learn something. Acting during uncertainty teaches less. It just drains you. Losses from early entries pile up quietly. They don't feel dramatic, they feel irritating. And irritation leads to more trades, tighter stops, lower quality decisions. Before long, the account is damaged not by one big mistake, but by many small ones rooted in the same impatience. Have you ever noticed how drawdowns often come from clusters of mediocre trades rather than one disaster? The market gives clear signals, but not on demand. It confirms through follow-through, not through hints. A real move defends levels. It holds gains. It attracts participation. Until those things happen, direction is irrelevant. You can be right about where price will go and still lose money because you were early. The market doesn't pay for being earlied. It pays for being aligned. That distinction matters more than most traders admit. Acting during uncertainty also distorts risk management. Stops are placed too close because there is no structure. Targets are vague because the move has not defined itself. You end up with poor reward to risk ratios without realizing it. When clarity is absent, your trade management becomes reactive instead of planned. Every decision feels improvised, and improvisation under financial pressure rarely ends well. There is a psychological addiction to action. Watching feels passive, acting feels responsible. Many traders confuse restraint with fear. In reality, restraint is professionalism. The best operators I've known were inactive most of the time. They waited while others churned. They preserved capital while others searched for excitement. They accepted uncertainty without trying to monetize it. And when the market finally revealed direction, they were ready, rested, and liquid. Losses from uncertainty sting differently. They don't feel instructive. They feel pointless. That's because they are. The market wasn't offering opportunity, it was offering observation. Acting turned observation into expense. Over time, those expenses compound into doubt. Doubt then pushes the trader to seek certainty where none exists. The cycle feeds itself. Breaking it requires recognizing that not all losses are equal. Some losses teach. Others simply punish impatience. Wealth in trading is built by participating selectively. You don't need to capture every move. You need to avoid the wrong environments. Uncertain markets are not neutral, they are hostile. They reward speed and scale you don't have. When you step aside during those periods, you're not missing out. You're preserving your edge. Do you measure success by how often you trade, or by how well you trade when it matters? The irony is that once you stop acting during uncertainty, direction becomes easier to read. Moves separate themselves. Fake signals fail quickly without trapping you. Real signals stand out because you're no longer desperate to see them everywhere. Patience sharpens perception. Capital stability calms the mind. The chart hasn't changed. You have. Most traders don't blow up from one wrong idea. They bleed from many early actions. That's where the damage begins. Capital preservation is the foundation of clear thinking. That idea sounds simple, almost boring, and that's exactly why most traders ignore it until the market forces the lesson on them. People come to trading obsessed with profit. But profit is a byproduct, not a starting point. The mind cannot function clearly when it feels threatened, and nothing threatens a trader faster than shrinking capital. Once money is bleeding, thinking becomes defensive, rushed, and emotional. Have you ever noticed how every chart looks more dangerous when your account is under pressure? When capital is intact, the mind stays open. You can observe without urgency. You can wait without anxiety. But when capital is damaged, every tick feels like judgment. Every pause feels suspicious. You stop reading the chart and start negotiating with it. This is where traders abandon their rules, not because the rules were bad, but because fear has taken the wheel. Preservation is not about being cautious. It's about staying mentally functional. Most bad decisions in trading are not made because the trader lacks knowledge. They are made because the trader is trying to recover. Recovery mode is poison to clarity. It shifts focus from process to outcome. Instead of asking, "Is this a good trade?" you ask, "Can this fix the damage?" The chart hasn't changed, but your interpretation has. That's why two traders can see the same setup and act completely differently. One is calm. The other is desperate. Which one do you think is preserving capital? Capital preservation also teaches respect for uncertainty. When you protect your downside, you give yourself permission to be wrong without panic. That permission is powerful. It allows you to exit cleanly, reassess, and wait for better alignment. Traders who risk too much cannot afford to be wrong, so they argue with the market. They widen stops. They add to losers. They convince themselves the market must turn because it has to. But the market doesn't care what you need. Isn't it strange how certainty increases exactly when risk control disappears? Preserving capital is not about avoiding losses. Losses are unavoidable. It's about controlling their size and frequency so they don't interfere with thinking. A small loss is information. A large loss is trauma. Trauma lingers. It affects the next trade and the one after that. Soon, you're not trading the market anymore. You're trading your emotional memory. The chart becomes secondary. That's why seasoned traders obsess over drawdowns more than wins. They know clarity disappears long before capital hits zero. There is also a subtle confidence that comes from preservation. Not arrogance, but quiet confidence. When you know one trade cannot hurt you badly, you stop forcing outcomes. You stop watching every tick. You let the trade work or fail on its own. That detachment improves execution more than any indicator ever will. The market rewards traders who are emotionally uninvested in being right. How can you stay detached if every trade threatens your account? Capital preservation reshapes time. When risk is small, time slows down. You can wait for confirmation. You can let a setup mature. When risk is large, time feels compressed. Every second matters. You jump in early. You exit late. You make decisions based on fear of missing out or fear of losing more. Preservation gives you time, and time gives you clarity. This is why professionals think in campaigns, not individual battles. Many traders misunderstand preservation as passivity. They think it means trading small forever or avoiding opportunity. That's not the case. Preservation is active discipline. It means choosing when to be aggressive and when to be invisible. You conserve capital during messy conditions so you can deploy it confidently when the market is clear. Aggression without preservation is gambling. Preservation without aggression is stagnation. The balance between the two defines long-term success. The market constantly tests your relationship with money. It tempts you to overexpose during uncertainty and underexpose during clarity. Capital preservation flips that instinct. You risk least when you know least. You risk more when the market shows its hand. That simple inversion separates professionals from amateurs. But it requires trust in process, not hope in outcome. Do you trust your process enough to protect yourself when nothing is obvious? Clear thinking is fragile. It depends on emotional stability, which depends on financial stability. Once the chain breaks, recovery is slow. Traders often think they can think their way out of a drawdown. In reality, they must trade their way out carefully, or not trade at all. Preservation shortens recovery because it prevents damage in the first place. It's easier to stay sharp than to become sharp again. Wealth in trading is built quietly through survival. Big wins get attention, but survival builds careers. The trader who stays solvent stays learning. The trader who preserves capital stays present. Over time, clarity compounds just like money does. You start seeing what matters faster. You stop reacting to noise. You recognize when conditions are hostile and when they are inviting. Capital preservation doesn't feel heroic. It feels restrained. But restraint is what keeps the mind clear enough to recognize opportunity when it finally arrives. That's where real control begins. Failed moves are information, not personal attacks, but the average trader experiences them as insults. A breakout fails, and it feels like the market singled you out. A reversal doesn't follow through, and suddenly you question your judgment, your method, even your place in the game. That reaction has nothing to do with the chart. It has everything to do with ego. The market does not know you exist. It cannot mock you. It can only reveal behavior. The moment you take a failed move personally, you stop learning from it. Every failed move tells a story about supply and demand that was not ready, not strong enough, or not aligned. Price attempted something and was rejected. That rejection is not noise, it is a message. But you only hear it if you are not emotionally attached to being right. When traders fixate on the loss instead of the message, they miss the lesson entirely. Have you ever noticed how the same pattern that fails often leads to a stronger move later? Most traders treat failure as proof of error. That's a mistake. Failure is often proof of timing, not thesis. A stock breaks out and falls back, not because the idea was wrong, but because the market needed to shake out weak hands. That failed breakout tells you where resistance actually lives and who is in control. But if you're busy feeling wrong, you won't see it. You'll either revenge trade or walk away discouraged, leaving the real opportunity untouched. The market tests conviction before it rewards it. Failed moves are part of that test. They expose where participants are impatient, undercapitalized, or emotionally involved. When a move fails quickly and cleanly, it's often revealing strength beneath the surface. When it fails slowly and messily, it's revealing distribution. Both are valuable. Neither is an insult, but value is only extracted by traders who remain emotionally neutral. Can you observe a failed trade without immediately assigning blame? Personalizing failure leads to defensive behavior. You tighten stops too much. You hesitate on valid entries. You start filtering setups not by quality, but by fear of being wrong again. The market hasn't changed, but your lens has. That distortion costs far more than the original loss. One failed move, misunderstood, can quietly sabotage 10 good trades that follow. There is also a tendency to label failed moves as traps, as if the market deliberately lured you in. That language reveals mindset. The market doesn't trap individuals, it exposes imbalance. When too many participants lean the same way without sufficient backing, price corrects them. That correction feels like betrayal only if you believe the market owed you continuation. It doesn't. It only reflects participation. When participation disappears, price responds accordingly. Failed moves often clarify structure better than successful ones. A failed breakdown that snaps back tells you demand is stronger than it appeared. A failed rally that cannot reclaim highs tells you supply is waiting. These are high-quality signals, but only after the fact. They require patience and observation. Traders who rush to erase the emotional discomfort of failure miss the structural clarity it provides. Why rush to forget what the market just revealed? Money mindset plays a quiet role here. Traders who risk too much experience failed moves as threats. Traders who risk appropriately experience them as data. The size of the loss often determines the size of the emotional reaction. When losses are manageable, curiosity replaces anger. When losses hurt, curiosity shuts down. That's why risk control is not just protection for capital, but protection for perception. There's also a deeper lesson in repeated failures at the same level. The market is showing you where consensus exists and where it doesn't. If a level keeps rejecting price, it matters. If breakouts keep failing, the crowd is early. That information is invaluable. Many of the best trades come not from the initial move, but from the second attempt after failure has cleared the field. Failed moves often prepare the ground for real ones. The trader who understands this stops reacting emotionally to failure. He starts cataloging it. He notes how price behaves after rejection. He watches volume on the failure, not just the entry. He learns which failures are weak and which are aggressive. Over time, he begins to recognize failure as a condition, not a verdict. That shift alone changes how he trades. Taking failed moves personally also encourages isolation. Traders hide losses, mentally or literally. They stop reviewing them objectively. But failed trades deserve the most attention, not the least. They show you where your expectations didn't match reality. That gap is where growth happens. Avoiding it only guarantees repetition. The market does not reward sensitivity, it rewards resilience and observation. Failed moves are part of the language of price. Ignoring them is like ignoring half the conversation. You don't have to like failure, but you do have to respect it. Respect turns disappointment into information. Information turns confusion into structure. The trader who survives learns to detach identity from outcome. A failed move does not say anything about you. It says something about timing, participation, and pressure. Once you accept that, failure loses its sting and gains its value. That's when failed moves start working for you.